It's been a while since we've seen red on the screen, hasn't it?
Yes, it has.
Sit here searching for answers like, wow, you mean stocks actually go down now?
Crazy.
Yeah, so what do you think lies ahead, given how far we've come in a reasonably short period of time?
In a very quick moment of time.
Yeah.
I was reading this amazing stat that the equal weight index went from a 52-week low to a 52-week high in 33 days, the fastest since 1982. So just one of many ways to see how quickly the narrative has changed. And I think we've gotten to the other extreme, one where it's become too focused on just chasing whatever is cyclical, whatever has lagged, and that's the story, and pricing in rate cuts as soon as March. Now we're talking about 6. You know, we've gone to the other extreme. So I think it would be perfectly natural to have certain down days, to consolidate a bit, maybe even have a bit of a pullback early next year before ultimately we move higher. We do have somewhat of a broadening of the rally, but still focus more on quality than just pure cyclicality.
Has more than the narrative changed? You say the narrative's changed. It obviously has.
Yeah.
Have the fundamentals changed along with the narrative, given this pivot that the Fed's done, some of the data around inflation and around the economy itself?
I do think that something did change last week, and it's important. And that was really the Fed's reaction function, right? For a year and a half, it was all about fighting inflation, the economy, you know, be darned, whatever happens there. It was all about the inflation side of the mandate. And very clearly, we heard last week that that's not the case anymore. There's more comfort about the disinflation process. There's more of a balance between the two sides of the mandate. And the Fed is not willing to tolerate economic pain because they feel more comfortable we're going in the disinflationary route anyway. So they can be more proactive versus reactive. And so you took the risk off the table that real rates can continue to rise next year, and that they're continuing to step on the brakes.
The risk of leaving rates too high for too long at this point.
Exactly.
Rather than suggesting, well, they might not be high enough, that's where we were not that long ago. Remember, it was like err on the side of doing too much. Don't make the same mistakes we've made 40 years ago. Let's err on that side. Now it's sort of, well, let's not do too much and wreck a good thing.
Exactly. And there's been so much debate since the meeting last week about what exactly led to the pivot. There are many explanations. We take the view that it's more actually the constructive explanation, which is just that inflation has continued to move down. We've unwound 60% of the core inflation pandemic surge at the same time that the unemployment rate has stayed below 4% for 22 months. So you can have resilient growth and continue to make progress towards the 2% inflation mandate. And for us, it took a while, actually, for them to acknowledge it, but better late than never. And it actually increases the odds of the cycle extending next year.
You're a believer in the broadening?
We are, but too much of a good thing.
Well, we had too much of a good thing
lately? I think so, because if you look at the top performers since late October, it's very, very cyclical bits of the market, like regional banks, home builders, small caps. And just saying that the Fed is proactive and we're extending the cycle, it doesn't mean everything is rosy and perfect. It still means the economy slows down a bit. It still means we're late cycle. It still means real rates are very restrictive.
You still think we're late cycle? Very late cycle.
And I think that's where I'm excited for the conversation to go next year. Less hard landing, soft landing, and more, where are we in the cycle? And we do think, if you look at the unemployment rate and that stat of it being below 4% for nearly 2 years, that's screaming late cycle. But late cycle can extend for years. We saw that with the last cycle. It doesn't mean we're expecting a imminent recession. It just means you have to focus a lot more about quality in that kind of environment and not just lean purely to cyclicality.